chapter 3 handout. Well, hopefully we might finish that. We'll see if we finish it. And then we should finish up the classical sampling. Should be able to finish this. Okay. Let's jump into any question on the CPA exam stuff? Let's see, ethics handout. Okay, I think we got through a couple of pages of this. All right. So direct, let's go back just to make sure we got this. The covered members are people that are going to be held to a higher standard. So these are people that are going to be held to a higher standard when it comes to a client. So for instance, if this is the IBM audit, any partner in the office, anyone working on the IBM audit is going to be a covered member. Consulting partners and managers are covered members if they have 10 hours or more of contact with the client. And then I just did something wrong here. And then just anyone who's influenced to influence the audit firm itself, and any entity that's controlled by covered members is also a covered member. Okay, and covered members cannot own any direct interest, and they can only own indirect financial interest if it is immaterial. And I know that immateriality and materiality, those are kind of judgment calls, but yeah. Okay. Immediate family members. One of the kind of loopholes we could think of is flipping up here. One of the loopholes, you say, okay, I know I own IBM stock and I got this IBM owner. I know I'll give the shares of stock to my wife, or I'll give it to my husband or my kid. We give it to someone. Then I'll be okay, right? Well, actually, no. If it is an immediate family member, and this is spouses, spousal equivalents, boyfriends, girlfriends, that kind of thing. I in there. No, A in there. And dependent children. So these are really who we're talking about as far as immediate family members. I should say the same as. So spouses, spousal equivalents, and dependent children are considered to be the same as the covered member. So basically, it's the same one you see when you go home. Whoever it is, your husband, your wife, or whatever, and your kids, the dependent children. Anyone you see when you go home is basically going to be considered your immediate family, and anything that those people own, any shares, or we'll get to later employment, those are considered to be one and the same as the covered member themselves. So if you give the stock to your dependent child, it's the same thing as you owning it still. So, the immediate family members are considered to be exactly the same as the covered member themselves. Okay. Sharon is a member of the audit engagement team for IBM. She's not owning any shares of IBM stock. Her husband owns 10,000 shares of IBM stock. Okay. So is Sharon a covered member?
Yes.
Yep. Is this a direct interest or indirect?
Direct.
Direct. Material or immaterial?
Material.
Probably material, but quite honestly, in this case, it doesn't matter. You know, even if it was immaterial, it wouldn't matter. Is she in violation of the independence rules?
Yes.
Yep. It's a spouse. They're considered the same as the covered member themselves. Let me make that green, maybe. So they cannot own one share of stock. So any immediate family member cannot own even one share of stock or one bond of the client. So, and immateriality doesn't matter. You know, when one share is the same as 10,000 shares. Okay. Steve's a member of the audit engagement team for IBM. He does not own any shares of IBM stock, but his dependent daughter owns an immaterial amount of IBM. Okay, covered member. Yep. Direct or indirect interest?
Direct interest.
Right.
Yep. And they tell us it's immaterial. In violation?
No.
Actually, yes. Yeah, because the daughter is considered the same, this is a dependent daughter. If it was a non-dependent daughter, it would be no. But this is a dependent daughter. So it's considered the same as Steve owning the direct interest in the stock.
And it doesn't matter whether it's material or immaterial.
Exactly. Yep. Yeah. Well, yeah. When it comes to direct ownership, you can't have it. Period. So any direct ownership, you know, one share of stock kicks you out. Okay, Jolene is a member of the audit engagement team. Okay, so she's a covered member. She not own any shares of IBM stock, but her husband has a large investment in a technology fund. 40% of the technology funds holding are in IBM stock. Okay, direct or indirect interest?
Indirect.
Indirect.
Direct, yep, good. Material or not? It's a little bit of a judgment call, but what do you think? A large investment in a fund, and the fund has 40% of the stock is in, the fund's holdings are in IBM stock.
Material.
Probably material, yeah. Yeah, 40%, you know, so if something happened to IBM, something would certainly happen to this fund, right? I mean, if it would move the fund quite a bit if IBM stock went up or down. And because it has a large investment, if it had a small investment, it probably, you know, it could very well be immaterial. But because it's a large investment, I'm assuming it's large compared to his other holdings. Is Jolene in violation of the independence rules?
Yes.
Yes.
Because in this case, materiality does make a difference. Because it's indirect. I should have gone over those again, actually. Yeah, because it's indirect. It's okay if it's immaterial. If it's material, then it's a no-no. So materiality does play a part in this one because it's indirect. Okay, close relatives and friends. Okay, so now we're moving a little bit out from the immediate circle of the family and say, okay, who else can come into play as far as someone's independence goes. And this is generally your parents, siblings, oops. Non-dependent children. And of course, friends. Oops, hold on, let me fix that. So these are the close relatives and friends. So parents, siblings, non-dependent children. So these are, so your parents, your brothers and sisters, and your children that are no longer dependent upon you. And the rules here are that they can have an immaterial indirect or direct, direct or indirect material let me start over again. Immaterial, direct or indirect okay, so immaterial and it could be direct or indirect. So they can only have a direct interest in the client as long as it's not material. May own a material indirect or direct interest in the client if it is unknown to the covered member. Okay, so let me talk about that one for you. All right, let's go ahead and highlight these. Let's see what I have to do. Okay. So may own a material direct interest in the client if it is unknown to the covered member. Okay, now this goes to, family relationships or whatever, that you may have people that haven't even talked to each other for 20 years. You'll have brothers that haven't talked to each other for 20 years. So if they don't know about any material interest, it won't bias them as far as the audit is concerned if they don't know about it. And sometimes, even if they are on good speaking terms, they don't sit there around and talk about, hey, I just bought a bunch of IBM stock, that probably doesn't, that very well may not come up. So if it's not known to the covered member, then it's okay if it's, even if it's material. And then you come into the situation of, well, gee, what if, what if someone's lying about it or something like that? But, if it's unknown, then they're not going to be held to that higher standard. So if it's immaterial, it's fine. If it's material, it's fine only if it is unknown. If it's known, then it's not okay. Okay.
Would the close family friend or whatever have to then sell whatever their interest is? If like they're having a casual conversation, it's like, oh man, my IBM stock is like through the roof, and the person's like, I am doing the audit for IBM. You have to sell your stock now. Like, is that how that would have to shake out?
Yeah, and actually one of the questions on here relates to that. But if it's not material, it doesn't matter. So even if they're, oh, I was actually, well, how much you got in there? Oh, I got 100 shares. It probably isn't material, but it depends on whether it's material or not. Now, if it is material, then you do run into a problem, and there's one on here. And by the way, there have been lawsuits about. I know that there have been a lot of cases about this, because notice that it's you're unlike your immediate family, where you probably have some control over it. It's something you don't have control over, and at the same time, there are laws about a right to make a living, and say, okay, well, just because my jerk brother won't sell his stock, I can't do an audit. So it does get to be a little bit more sticky in this situation, because it's not controlled. It's not controlled by the actual covered member. Okay. Wanda, member of engagement team. Okay, so covered member. She does not own any shares of IBM stock, but knows that her sister owns 500 shares. Okay, so direct or indirect?
Direct.
Thanks, Sarah.
And it's immaterial. So is Wanda in violation of the rules?
No.
Nope. It's direct, but it's immaterial to her sister, so it's okay. Stacy is a member of the audit engagement team for IBM. Okay, so covered member. Do you know any IBM staffman knows her brother owns 300 shares? Direct interest. It's material to her brother. Is Stacy in violation of the rules?
Yes.
Yes. Now notice that it isn't the number of shares. Oops, sorry. It goes by if it's material or not to her brother. Lawrence is the audit engagement team. He's not only shares of IBM stock, but his father has a material investment in IBM stock. Lawrence does not know about this, about his father's IBM investment. Okay, so Lawrence is a covered member. His dad has a direct interest in it, and it's material. Is Lawrence in violation? Nope, doesn't know about it. Okay, May is member of the audit engagement team. Okay, covered member. She does not own any shares of IBM stock, but her mother has a material investment in IBM stock. So material. It's direct, it's material. May knows about the investment and asks her mother to sell it. Her mother refuses to sell the stock. Oops, I got my answer here got cut off. Is May in violation of the independence rules?
Yes.
Yep.
So in that situation, would May then have to just like tell her boss, I can't do this audit, you have to put me on a different assignment?
Yeah. And again, there have been, I know that, I don't know how they actually unfolded, but I know there has been legal challenges to some of those rules because it's out of their control. The current member isn't doing anything. I'll tell you another, like a strange one. There was a case where someone was doing an audit and their father died. And her father had a direct interest in the client. Well, okay, now it's going into, probate and all that kind of stuff, but it's possible that, with the person doing the audit, that they had now a direct interest in it, but now there's all these other family members in that, and there's a bunch of legal stuff as far as like selling the stock and all that. It can get these rules can get a little bit tricky for by other factors other than those that are under the control of the covered member. Covered member probably didn't want their father to die, and probably didn't doesn't want them owning the stock or whatever, but yeah, these rules are a little bit trickier than say the ones of the immediate family are a little bit clearer because they do have usually some control over those. Okay. And by the way, just let you know, there's a million combinations of stuff. So he's okay. What about my I have a second cousin, who owns some shares or whatever. Well, you probably say, okay, no, not second cousin's not going to be a close relative or anything like that. But you don't know. The family situation might have been, maybe I raised my second cousin as if it was my own child since they were 10 years old. You don't know. There's all kinds of well, if this but that sort of things in there. I think they stopped doing this, but they used to have the ACCT433 used to have a thing on you had a situation like that, you could put it into them and say, well, is this okay or is this not okay? And I think when I was going through, they were up to like 500 of these cases. Then they would sit around and debate, what would the outcome be, and to give you like a kind of a guideline of, okay, what about this situation? What about that situation? But there's really like 500. I mean, it wasn't like 2 or 3. It was hundreds of different scenarios. Okay. Employment interest of covered members. I think I'm going to do this on. Bear with me 1 second. Focus. Doggy focus. Okay. So the different scenarios you can get for employment interest, and this is if you have a client and the CPA firm, and if you have an employee from the client go over to the CPA firm. So the employee goes from being employed by the client over to the CPA firm. Now, this is rare. Could it happen? Yeah, I'm sure it does happen, but it's fairly rare. A more common one is client and the CPA firm. And an employee goes from the CPA firm to the client. This is common. So it's rare to go this way. CPA firms usually they get you right out of school, and that's how you get into them. So rarely would you have someone come over, unless they had some kind of special computer or something or whatever. Usually not. And again, you don't want to irritate a client by stealing an employee. But these are more common. You have someone going from the CPA firm into the client. All right. Okay, so client's employee gets hired by the CPA firm. The new CPA firm employee cannot work on an audit that, as you say, includes their own work. Okay, so, oops, that's not me. So let's say you get an employee from IBM. Now, if you're in the CPA firm, it might be reasonable to say, oh, well, good, we got this employee from IBM, we'll put them on the IBM audit. After all, they'll know more about IBM than any of us, right? I mean, they've worked there for however long. They can't be on the audit if they're going to be auditing some of their own work. So now, as time goes by, if time goes by and their work is no longer included in the audit, they've been out of the IBM or whoever the client is for a year or whatever, then they can work on the audit. But they can't audit their own work. Is basically the rule for that. Okay. Oh, hey, here we go. I should have just read down further. Gracie worked for IBM accounting department and was recently laid off from her position. Gracie took a job with the IBM auditors. Can Gracie participate in IBM audit?
No.
Nope. Most likely she'd be auditing her own work. Working in the accounting department. Now, it is possible if she's working in a different department that she could, but because she worked in the accounting department, most likely not. Okay. CPA firm employee gets hired by a client, very common. Now there's two different rules for these. What I have on there is really a little bit misleading, and I'll tell you why in a second. But there are the rules for the non-issuers, for the privately held companies that are not regulated by the SEC. There are those rules. They're a little bit more lenient than the other rules. The rules by the SEC are more commonly the PCAOB rules. However, it doesn't mean that the client does not have to follow the AICPA rules, which are usually state laws, they do. So if you're a publicly traded company, if you're doing an audit for a publicly traded company, not only do you have to follow your rules, you also have to follow for the PCAOB rules. You also have to follow the AICPA rules. So it isn't like you get out of it, out of the AICPA rules. Those still apply to both of them. So this, I got it here for just convenient, but a non-issuer, but this would also go for issuers too. So issuers must also follow the rules above. All right, well, what are the rules? How about that?
We are looking at you, not your screen.
That sounds like a bummer. Okay, here we go. Okay, this perspective, thank you. Oops, must be taken off of the audit if they have accepted the offer or are considering it. Okay. So if they have accepted the offer or are considering the offer, they must be taken off the audit. So, the plan is going over here. Now, if they have already accepted it, or they haven't rejected the offer, basically, they must be taken off the audit. Now, if they've rejected it, then there's no problem. Right? I mean, if they're not going over to IBM or whatever, then there's not a problem. Okay. Client is an issuer. If the offer for a key financials key financial position the production employee must have been off of the audit for an entire audit cycle. Say 1+ year. And this one gets to be a little bit tricky. I'll show you why. Sort of like this. So let's say that they are, let's say that this is 2022, 23, and 2024. Let's say that you get the offer on March 1st, 2022. You gotta be off the audit for an entire audit cycle. So here's the audit cycle, is the entire year. You're not off it for the entire audit cycle. Go to the next year, you have to be off for this entire audit cycle before you can take the job. So you could actually end up taking this job in 1/1/2024. So it's offer in 2022, you actually be able to take it until January 1st, 2024. So, you know, this is an audit cycle. Now, this is only for a key financial position. Can't spell. It's not a key financial position. This doesn't apply for a key financial position. It must be offered for the entire audit cycle. Now, you might say, well, why? You know, why do you have to be offered for an entire audit cycle? Why do that have to do with anything? Well, it has to go by if it's a key financial position, more than likely the person being offered that key financial position is high up in the CPA firm, right? You know, they don't just offer controller positions just to anybody. You gotta, you know, you gotta have been around the block for a while. So when they go for those the higher level positions in the audit firm, those are probably the same people that have trained many of the people who are actually doing the audit. So you run into the circumstance where someone might take a job as a controller or a chief financial officer coming out of a CPA firm. They go in to do the audit, and all the people doing the audit are the exact same people who are trained by this person. So they're sitting across from their mentor / former boss, and quite honestly, probably somebody who they'll want to get a reference from at some point in the future. That's who they're sitting across the desk from when they're doing the audit. So the feeling was that, look, this is a bad situation to have, that, you know, if you have this kind of almost a conflict of the professional interest of the employees, but also that it gives the company more of a free rein to do, you know, what they want, basically, because, you know, here they have this person has this kind of a mentor / you know, former employer thing with the people that are sitting across the table from them. So that's why this came about. And again, this is only for key positions, because that's the only, you know, usually, especially in larger companies, that's who is going to get these key positions of people higher up in the CPA firms. Okay, so issuer rule. Oh, by the way, let me put this down here too. the ACCT, so these rules up here still apply to, you know, these rules still apply to those. This is just an added rule on top of it. So even if it is, so it's a public trading company, even if it is, if you're not going for a key position and you've accepted the offer or are considering it, you still have to be taken off the audit. You know, you say, well, I'm an issuer, I follow the, you know, that's fine, but the AICPA rules say that you have to come off the audit before, you know, while you're considering it, or if you've accepted the offer, you have to come off the audit. So that those rules are still in effect, even for issuers. So this is maybe, I should say, maybe an added rule for issuers. Okay. So issuer. Sam is a member of the IBM audit team. He's offered an IBM job. He has not accepted or rejected the offer. Can Sam work on the IBM audit?
No.
Nope. George is a member of the IBM audit team. He has recently got a job offer from IBM. The IBM job is for a staff accountant. Can George immediately accept the job offer?
Yes.
Yeah, this is probably not a key financial position. You know, the staff accountant probably is not a key financial position. Oh, by the way, I should mention this also. Up until a couple years ago, it was just key position. So if you went into the if you went into operations or something like that, it's considered a key position. The new rules are that it must be a key financial position. So people like chief financial officer, controller, those people, the treasurer, those people that are directly tied in, it's a financial position, someone who has an influence over the financial statements. So it's a key financial position, not just a key position. Okay. Lisa is a member of the audit engagement team. She usually got a job offer IBM. Job is for a controller position. Can you accept the job immediately?
No.
Nope. Key financial position. Okay, non-issuer. Mickey is a member of the GeoCorp audit engagement team. GeoCorp is a privately held company. She recently got a job, Mickey recently got a job offer from GeoCorp as the chief financial officer. Can Mickey accept the job offer?
Yes.
Yes, very good. Most people miss this one. Yeah, if it's not publicly traded, you can definitely, you can take a key financial position. It's only for those that are publicly traded. If you think about it, generally the non-issuers are smaller firm or smaller clients. And so if you're leaving a CPA firm, it wouldn't be that unusual that, leaving any CPA firm that you might fall into a higher category in a smaller company. If they only have 5 accounting people and you've been working for, whatever, that, it's probably more likely that you'd have somebody who would go into those, naturally go into those higher positions. They're probably not going to start out as a beginning accountant if they've been working in CPA firms for years. Okay. Okay, reoccurring for theme here. Family and close relatives cannot occupy key financial positions. Oops. That's why I say with the client. Okay, and again, this is something that recurs time and time again. And that is key financial positions. So now let's think about this, just to be clear though. So this is for family members and close relatives, generally speaking. You'll notice that generally speaking, we're not talking about friends, and there's a reason for that. And part of the reason is a lot of times there is a relationship between the auditors and people within the company themselves. They may even consider themselves friends. So, just because you're friends doesn't necessarily count you out here. So, but this is for close family, family and relatives, close family and relatives, usually your immediate family, and then also, your spouse and dependent children, but also going into your siblings and parents and that sort of thing. And if they have a key position, then it is a violation. Sam was a member of the Up One corporate audit engagement team. Sam's mother is the chief financial officer of Up One. Is Sam in violation of the independence rules?
Yes.
Yep. His mother is a close relative. And this, and these again are, I kind of doubt you're gonna get a close relative to quit a job, chief financial officer to do an audit. But. Okay, Mary is a member of the Up Two corporate audit engagement team. Mary's father is director of design at Up Two. Is Mary in violation?
No.
Nope, good, not financial. So it makes a difference whether it's financial or not. So a key financial position. So this financial is important. Up to about 3 years ago, this would have been in violation, but not now. Okay. So independence, employment, and financial interests of non-covered members. All right, I'm gonna go all the way back up to the beginning. You say, okay, well, what about these other people? What about this person or this person or this person? What, there's no rules for these people. Can they just do whatever they want? And the answer is no. They have much more leeway, but so we're talking about non-covered members, partners, and professional staff. So this is within the CPA firm. Okay, financial interest. Non-covered members cannot own more than 5%. Oops. So non-covered members cannot own more than 5% of the client. So, coming up here, if you had a manager that can they own IBM stock? Yeah. They can't own more than 5% of it. That'd be quite honest for a CPA for a publicly traded company. If someone owned 5% of the stock, they'd probably be living on an island somewhere. I mean, it's a pretty big investment. But it could happen though, especially with smaller company. A smaller company, let's say it's a grocery store chain, a family-run business that has grocery stores, like 10 grocery stores, and one of their children goes off to college, goes into accounting, gets in with a CPA firm. They might be doing an audit of that family business, and maybe they own 10% of it. So while for publicly traded companies, I would say it's probably quite rare because it takes such a huge amount of money for a lot of them to, to get to 5%. It's certainly for smaller clients, you could run into that situation. Okay. So they cannot, well, they can own direct interest in the stock as long as it is not more than 5% of the client. Where am I? Okay. Employment issues. Or non-government members cannot participate in upper management or oversight positions with the client. And the oversight positions we're talking about are directors. Okay, so they can't participate in upper management. That should be obvious. But those non-government members can also not be on things like the board of directors, which, by the way, it's not that uncommon to have partners and people in the high up in CPA firms be asked to be on board of directors. Sometimes it's honorary, and if it's completely honorary, sometimes whatever, like for a school district or something like that, maybe they want to, they want to just say, okay, well, look at all these good people we have guiding us along, and they just want your name on there so that they can say, look, and you don't vote on anything, and they, twice a year you go have coffee and cookies somewhere. That's okay, but if you're on if you're actually voting on it and participating, then it's a no-no. Okay, James is a senior auditor for a CPA firm that audits IBM. However, James is not a covered member. CPA firm. There's also an ordained minister and releases a position on IBM's board of directors as a spiritual director. James is not on the audit committee at IBM. Will James' position impact the CPA firm's independence? Yes or no?
No.
Actually, it's yes. So,
Even with him being spiritual director, doesn't really have anything to do with anything.
Well, it's a board of directors. So if they're part of the oversight, and two, you don't want to, you remember that a big part of this is the appearance. Now, it may have, you're absolutely right that it probably doesn't have anything to do with the financial statements. But what you don't want to have is, IBM, they did this audit of IBM, and they actually had someone on the board of directors, from the firms on, board of directors for IBM. How independent are they? So even though it might be, completely on the up and up, remember we have to be independent as far as fact and appearance. So even though in fact it, most likely is completely on the up and up, the appearance could be that, look, you got somebody on the board of directors, you're not independent. And most people on the board, a lot of people on the board of directors, it takes a whole bunch of money to get them there. So, while it is, for a good reason that they're there, it's also, it makes the entire CPA firm not independent. Let's take a break. Let me see what we come next. There's a lot in this. You know what? When we come back, I think we'll go into the Let's take a break. When we come back, we'll go into the classical sampling. We'll finish that one up. I don't think we finished that one up last time. Yeah, so we'll go ahead and go into the classical sampling. Okay, so let's go ahead and take a break and pull up classical sampling. For number 4. Yep. Okay, so we'll say be back. Let's say 7:10. Might get out a little early tonight. That's fine. Okay. Okay, let's go ahead and go into classical sampling. We'll finish this thing up. And then we will, I want to go into talked about it a little bit already. But when you use these different ways of doing it. Okay. This I am 100% sure was on a CPA, is the format that was on a CPA exam in the past. And on a CPA exam, what they would end up doing is giving you this. And then they would probably end up asking you questions on what would be the projected misstatement using the mean per unit. You know, be more specific than are putting in all the information here. So a lot of times you'll see that they'll give like this, you know, this kind of a data and then say what's the projected misstatement using the difference estimation or whatever it is. Okay. The average of the audits. So the sample size is 60. And this was what the okay, so 1800 and the divided by the 60 units in the sample. Can't glasses on. Equals 30. I'm gonna use a calculator. Plus,
It's 30.
30. Okay.
Yeah.
Like using my calculator cam.
Well, I practiced the problem in advance, so that's why.
Okay. So this is the audit average.
Yep.
And let's make that. Pass me a yellow. And then the book. Oops. $33?
Yep.
Okay. Oops. Okay. Okay, which number is more reliable, the audit average or the book average?
Audit.
Audit. Yep, this is the better of those two because we did it ourselves. We know exactly what it is rather than someone handing us the yeah. Okay, so oops. 33 for the book average. All right. So the mean per unit. And one of the things, you know, hopefully you get kind of just used to instead of relying on the formula, it's kind of just thinking what it is, mean per unit, mean being the average. Per unit. And again, whose average do you want to believe? Well, you put more, you know, you believe more strongly in what numbers you came up with than the numbers they came up with. So total number of sales is 20,000. Okay, so $20,000 sales. equals
600,000.
Okay. So we're saying that it should be 600,000. And again, this method, it completely ignores the average book value. This is the one that doesn't do it. Wait a minute, that should be yellow. It completely ignores the book value. It says, okay, we don't care about that. We came up with $30, everything should be $30. Protected misstatement, take the book value. That's what I did up here. Yeah, okay. I'll copy this down, just keep it the same. It is a bigger font. It's a 12 instead of 11. I'm gonna make you 11. Fit in. Okay. So the book value was 700,000. Projected value is 600,000. So the projected misstatement is 100. And on the exam, they'll usually ask you if it's overstated or understated. So the 100,000, is it overstated or understated?
Overstated.
Yep. Perfect. So this would be overstated. We're saying it should be 600,000. They have 700,000 on their books. So we're saying that they have overstated their sales by 100,000. Ratio estimation. Ratio estimation, that's not me. Ratio estimation, in my opinion, is probably the one that's most useful and probably the one that relates mostly to the types of audits you're going to do. And that is, small items usually have small errors, large items have large errors. You know, $100 account probably is not going to have a $60,000 error. It could, but not usually. You know, now if you have a $3 million account, a $60,000 error may not be that unusual. But you know, so small things, small errors, big things, big errors, and I think that's probably pretty reasonable as far as most things go, as to how they actually work out. So you take the audit divided by the book, and if you forget which one goes where, it's alphabetical. Oops. So audit average divided by book average. Times the sales book value, or the book value of the sales, or however you want to put it. So the book value was 700,000. And notice that, you know, it's sort of like the book value, this is like the numerator and denominator in that, because this would be, what the ratio of those would be off by would be, whatever that is. All right, so. Divided by 33. Six, 3, 6, 3, 4. Wait a minute. I rounded off the nearest dollar. It is a projected value. So this is what we think that it really should be on the books for that account using the ratio estimation one. Now notice this one does take into account what the book average was of the sample. Okay. So this. So projected misstatement would be 63636. I'll just make this a more less confusing looking. Oh, that should be a period. That should be a. Okay, so there's a projected misstatement. Oops. And this is a. This is an overstatement, right? Okay, the last one, the difference estimation one is sort of different than the ratio estimation one in its entire concept. Ratio estimation says big errors, you know, big accounts, big errors, small accounts, small errors. Difference estimation says, okay, well, they could be, they'll be off by the same amount. And it could be that they are, you know, it could be some special handling charge or something like that that gets left off or whatever it is. Difference estimation is that they're off. If they are off, they're likely to be off by the same amount. Okay, so let's see. Italicized here for some reason. Okay, so move on to the next page. Oop. So subtract out the book value, you get a difference. So what we say here is that, look, we got to take off $3 from each item. So again, it's a little bit different than the other one in that it says, look, you know, we came up with it, we're off by $3 on each item, and that regardless of how big the account is, if it's a $50 account or if it's a $5,000 account, it's gonna be off by $3. Right, so that's what the difference estimation one is. And we're gonna say, okay, well, so, you know, what kind of adjustments they have to make? Well, if they have 20,000 sales, oops, multiply 20,000 sales. Did I say sales orders? Number of sales, okay. So 20,000 sales, so each sale is off by $3. So that would come out to be what, like negative 60,000? So in other words, we're saying that they have to take off 60,000 off of their sales. So they have to reduce it by 60,000. So the misstatement is 60,000. Now notice this one is different than the other ones in that this one we do the misstatement first. If I take off that negative. But is this going to be an overstatement or understatement? Are we saying the books are too high or too low?
Overstatement.
Yep. Now, so we kind of have to back into the projected value. Oops, let me try that again. So it's sort of like this. We don't know what this is yet. But we're saying the projected misstatement is a $60,000 overstatement. So what would the projected value be?
640.
Yep. So this is what would be the projected value. We did kind of back into it from this one. So if it's overstated by 60,000, you know, okay, so we have to reduce this by, we're saying that each item should be reduced by $3. So 60,000, we just subtract 60,000 from that, come up with the projected value of that. Okay. This one's very similar. I'm gonna let you guys do this one on your own. So this will be this one will be homework number 5. But I do want to do number 6 though, real quick here. And then we'll put the answer up to this. Next week, if you have any questions on it. But I want to go to the number 6 here. Okay, so a perfectly reasonable question would be, well, which one do we use? Right, they come up with different answers. And notice that, you know, the answers are different enough that it might be that, you know, this one is material, whereas maybe this one isn't. So the method that you use could definitely have an impact on your overall perception of the, whether it's fairly presented. Mean per unit is appropriate when Items in the sample are of similar size. So if there's similar size items in the sample, whatever they are, if they're making drill presses or whatever, that, they dollar wise, they're similar. They're going to be at 5,000 and 7,000 or whatever it is. If they're all kind of similar size, it's not a bad one to use. It's a good one to use. So mean per unit estimation, if they're all of similar size. So when items in the sample. When the items in the sample are likely to have errors proportionate to their size. In other words, larger items will have larger errors. So big items, big problems, small items, small problems. And again, I think this one is probably the best in most cases. Different estimation is appropriate when. Oops. I'm not sure if that not sure if that requires a comma there or not, but I'm putting it in. Okay, so any question on that? So you have to look at the characteristics of the sample before you know which method to use. Another thing I'll say about it too is that you can also break up a sample to have it fit into one of those groups, whether it's the mean per unit, the ratio, or the difference one. For instance, let's say they make 4 different products, but inside those products themselves, they're very similar in size, very similar in value. Whereas if you take all 4 products together, it might be all over the place. You could actually do 4 different samples. There's nothing wrong with doing that at all. Saying, okay, we're not going to do a sample of everything in the same sample. We can have 4 samples of the inventory, because then we can use the mean per unit one and it might get a more accurate number. So it isn't, you're not necessarily stuck to one just because of what the actual characteristics are. It's possible you can pick and choose which ones you use in different areas. So anyway, well, I'll give you just one crazy example. I worked at a Navistar, and we made diesel engines for, well, we made them for all kinds of things, but most of them went to Ford. We basically made the Ford diesel engine. They took something like 90% of our inventory went to Ford engines. So those are all the same for the most part. I mean, there wasn't too much variation in those engines. So, you could definitely have done a mean per unit estimation on those, because they're basically all the same engine going into it. Okay, so now some of you have already turned in the exam, so don't forget to turn in the exam by tomorrow, right? So turn it by tomorrow, and then you should have them graded. I'll look at them on Saturday probably. Now, one more thing I just want to say about the exams, and that is, I told you you can't turn them in. You can't resubmit an exam. If the exams have not been graded yet, then you can. I mean, once they're graded, the grade is whatever it is. But up until, and that's why one of the reasons why I usually kind of leave it open up until when the due date is that if you go, oh, I answered that question wrong. I just realized I answered that question wrong. You can resubmit it, and I'll take the second. If there's 2 submittals, I'll go to the second one, and assume that one is the one that you wanted. So as far as the exams are concerned, you can't retake the exams, but you can resubmit as long as they have not been graded yet. Any questions on that? Okay. Well, so for next week, finish up, hold on a second, let me share my screen. So for next week, do problem 5. And we'll put up the answers next week and make sure everyone's on the right track on that. And then just get the testing if you haven't already. Any questions? Okay, we got 20 minutes left, so I think we should all just put our heads down on the desk and wait for 20 minutes. Or you can just we just call it a night. I think we just call it a night. Okay, so I'll see you guys in a week's time. Next week we'll definitely finish the chapter 3 handout and do the multiple choice questions, and I'll send out the chapter 3 exam next week. And we will continue with the sampling and doing a few different things in sampling other than classical sampling. Okay, well, have a good weekend, and I will see you guys in a week's time.
Have a good night.
Good night.
Thank you, Professor.
Thank you. Have a good one.
I will, you too. Thank you.